All right, it looks like it's 7 o'clock here in Ohio, and time to get started with our webinar. We appreciate everybody that is online with us, and hopefully we can give you informative and enjoyable webinar. Tonight we're going to be looking at farm insurance and some of the key elements of farm insurance policies. What we want to hopefully have you take away from the webinar is maybe not so much a detailed explanation of, specifically what you need for your farming operation, but a general idea of how insurance works, and most importantly, what questions you should be asking your own insurance agent. So as we go through the presentation, just keep that in mind of, what should you be asking your insurance agent to make sure that your farm policy covers your farm business as thoroughly as it can. Okay. So I'm Robert Moore. I'm an attorney at Ohio State University, and I'm in the Agricultural and Resource Law program at Ohio State Extension. Prior to joining Ohio State about 2 years ago, I was in private practice for about 18 years and worked primarily with farmers and landowners. And while I was in private practice, one thing that I always wanted to do, but just never got around to it, was learning more about farm insurance. I always encouraged my clients to review their policies and talk to their insurance agents, make sure they have enough insurance. But I never had time myself to really do a deep dive into it. So when I joined Ohio State, this is one topic that I did want to learn more about. So as I started looking into farm insurance, I realized that it's a pretty complicated and technical topic, and it's not something that you just learn by sitting in front of your computer and reading. It's something that you have to do to really get some expertise in it. So I knew I had to get some help, and fortunately, uh, just coincidentally, that help found me. Um, I work with Jeff Lewis at Ohio State, and I was talking to Jeff one time, and he mentioned that before he joined Ohio State, he was with an insurance defense law firm. So I signed him up very quickly to help out with my insurance project. And I was working with Samantha Capaldo at the National Ag Law Center on a different project, and she happened to mention that she sold insurance before she went to law school. So I signed her up very quickly. So we have some real expertise with us tonight, some hands-on experience, people that have been in the insurance business, and I think you'll find their comments and their insight very useful. So with that, Samantha, do you want to go ahead and introduce yourself?
Sure. Hi, everyone. I'm Samantha Capaldo. I am a staff attorney at the National Agricultural Law Center, which is a division of the University of Arkansas Division of Agriculture. Primarily, I work on insurance, legal issues, and labor issues. Like Robert mentioned, prior to going to law school, I was an insurance agent in Virginia. So I'm licensed in both Virginia and North Carolina. And with that, I will turn it over to Jeff.
Yes, hi everyone. Good evening. As Robert mentioned, my name is Jeff Lewis. I work with Robert. I primarily work at the income tax schools at Ohio State University, but I work closely with the Ag Law program in researching insurance and writing about insurance, labor and employment, and taxes. And as Robert mentioned, prior to my stint at Ohio State, I was an insurance defense attorney where I represented various different clients for various different issues, some agricultural related, a lot not related to agriculture. So I do have some experience in the claim side of insurance.
Okay. Well, before we get started, just a couple housekeeping things. So our presentation tonight is meant to be informal. The three of us will be interacting and commenting throughout the session. And we would also appreciate if you do the same thing. If you have a question or a comment, type it into the chat button down there at the bottom, and we'll keep an eye on that. And as soon as we see a question or comment come up, we'll be glad to take that. So be sure to take advantage of Sam and Jeff's expertise and ask all the questions you want. We'd rather have a conversation and answer questions and address comments rather than just do a lecture. So again, we'll keep it pretty informal, pretty light. Feel free to join in on the conversation. Okay, with that, let's start in on the substantive material. So the first question is, do you need insurance? So in the legal profession, a lot of the times we don't like to give definitive answers. But on this question, I can give you a definitive answer, and that is yes. You need insurance. I need insurance. I think we all need insurance. And particularly for farming operations, with farming being such a capital intensive endeavor, that it's just difficult for a farm to lose assets and recover from that, be able to have the capital to replace that without insurance proceeds. So for the viability of your present and for the future of your farming operation, we definitely need insurance. So then the question becomes, what type of insurance and how much do we need? So those are the two primary questions we'll be addressing tonight, along with what type of questions should you be asking your insurance agent. Okay. So why spend time on a farm insurance policy review? And when I put this slide together, I intentionally put some cows on here, because when I started looking into this insurance project and how I was going to approach it, it was last spring. And about that time, you may remember there was a huge fire at a dairy in Texas, and 18,000 cows were killed. And there on the left is the barn. I measured it with Google Maps. It's like a 45-acre barn. It's massive. You can't really appreciate how big it is. And then on the right, you can see the smoke from the fire. But I was reading stories about it, and one of the stories was that 18,000 cows died, and they didn't know what to do with 18,000 cows, dead cows, because you can't compost them all at once. They have services that will take away dead animals, but not 18,000 at a time. Can they bury them? Well, now we got water quality, environmental issues. And my thought was, I hope their insurance will cover this. And I have no reason to think that it didn't or isn't covering that. But that was my initial thought of, what if the farm had a policy that covered the fire almost for sure, probably covered the loss of cows for sure, covered the loss of equipment, those sorts of things. But did it cover the disposal of a mass casualty event on the farm? And probably they had something in their policy that would, but what if they didn't? So that kind of stimulated this conversation. And just before we started tonight, Jeff was telling me about, he had done some more research on this, and the fire was actually started by a manure vacuum. And Jeff, do you want to talk about that and why the manufacturer of that vacuum might want to make sure they have good insurance?
Yeah, so this manure vacuum was a specially designed diesel tractor that they were pulling through the barn to vacuum out the manure between the stalls. And the reason that's important is because if there is some negligence or some product malfunction or something like that, where the insurance company, because it was labeled an accidental fire, and they had to pay out, is the insurance company going to sue the manufacturer now for negligence or a product liability claim to recoup that money that they had to pay out to the dairy farm?
So not only does the dairy farm need insurance, but the manufacturer of the vacuum should have insurance. So it goes back to the concept of we all need insurance. If we're out in the world, we need insurance, and let's work on getting the best insurance we can get. Okay. So this is another thought that has occurred to me. I've worked with a lot of farms on a lot of different farm management issues. And, we talk about farm management for income taxes and balance sheets and crop and grain marketing. But how often do we talk about farm insurance as part of that farm management package? And I would suggest that probably there's no other farm management tool that is as important but gets less attention than farm insurance. And that's what we're going to try to change, is we're going to try to get the word out of what is farm insurance, maybe understand it a little bit better, and again, make sure we develop a relationship with our insurance agents to, as best we can, limit the risk to our farms through having adequate insurance policies. Okay. So there's dozens, hundreds of types of coverage of insurance, I'm sure, but tonight we're just going to focus on liability insurance. So that's going to be if some event occurs that causes injury to property or injury or death to a person. Property damage, that's going to be when property that you own would be damaged through fire, wind, whatever kind of event. And then environmental pollution, spray drift, those sorts of things. So those are the three we're going to focus on tonight. And that's generally what you're going to find in your basic farm policies. All right, Jeff, I'm going to let you two experts take over this slide.
Yeah, so the types of coverages are very broad strokes. And when we talk about types of policies, those are when you get into the more specific details of what you are actually covering. So for example, your general business owner's policy probably isn't going to cover the same property that your commercial farm policy might, or your homeowner's insurance policy might. Think about your automobile policy. That's going to be covering, your vehicles that you drive on the road every day, and that's probably not going to cover your tractor if you're on the road. Some things that we talk about too when we talk about excess coverage, I saw a question come in, excess policies, and if I'm understanding, it might be the umbrella policy that we're talking about. And that umbrella policy goes above and beyond what your specific policy covers. So then your specific policies, say your automobile policy, for example, you get in a car accident, your automobile policy will cover that accident. But what if the damages are above and beyond your limits on the automobile policy? Well, if you have an umbrella policy, hopefully that umbrella policy will cover that excess. And I don't know if Sam, if you wanted to add some.
So with the umbrella policy, there's also something called an excess liability policy. They're very similar. They just have some slight differences. But really the umbrella policy is there to provide above and beyond your liability. It's not going to provide additional limits on a property policy. It's strictly there for liability. And you can schedule multiple types of policies on that specific umbrella policy. So you could have additional limits for a general liability policy, a personal liability, an automobile liability, employer's liability. Some companies will schedule pollution or other professional liability policies. So it's really there just to provide those extra limits in case there's an accident or event that goes above the limits on the underlying policy.
Hey, Sam, when we were talking a while back, and we were talking about that dairy farm, I think you had said something about that, the cows, the disposal of the cows may have been covered under an excess policy. Do I have that right? And could you explain what you meant by that?
So the individual cows would not be covered under the umbrella policy because that would be a property loss. Cows would be on a property policy.
Right.
But any environmental kind of cleanup could potentially, if the pollution or environmental coverage is scheduled as an underlying coverage on the umbrella policy, there could be limits there.
Okay.
Anything else? Nope.
Okay, so before we get into the actual insurance policies, I thought I would talk a little bit about business entities. This is more of what I deal with, business and estate planning type things. So a question that we hear quite a bit is, well, do I need insurance if I have a business entity? And do I need a business entity if I have insurance? And the question, like most legal, the answer, like most legal answers, is, well, it depends. So let's talk a little bit about business entities and kind of get those out of the way so we can have an understanding of when they might help and when they may be of limited value. So the first thing to address is, what type of business entity are we talking about? General partnerships have no liability protection. So if you're farming in a general partnership, no liability protection. You are liable for all the other partners, employees, no liability separation. There are a lot of limited partnerships in farming operations, and how that works is the limited partners, who are usually the non-voting partners, do have liability protection, but the general partners do not. So if you are a general partner of a limited partnership, you probably do not have any liability protection. So the preferable entity to have for liability protection are LLCs and corporations. And essentially what these two entities do is they separate the owners from the business, so that if the business has some kind of liability issue, that it doesn't go back to the owner and all of their assets outside of the entity. So if you have a general partnership or a limited partnership, you may think about converting that over to an LLC or corporation. Okay. So what do entities do and what don't they do? So I would say entities provide a good backup liability. And that's because the entity does not protect the assets in the entity. It only severs the liability for the owners. Okay. So if we put machinery, equipment, trucks in an LLC and something happens with that LLC, well, all the assets that are in that LLC are still at risk. So we still need insurance to cover those assets in the LLCs. In my opinion, entities should not be the primary liability plan. They should be the backup. Insurance should always be the primary risk management tool on your farming operation. And I've told many clients over the years that talk about, well, should I have a business entity for liability protection? I usually ask, well, how much liability insurance do you have? And what would it cost to get more? And once you answer those questions, make sure you have adequate insurance coverage. Then let's talk about, should we put in an LLC to give you an extra layer of liability protection? Do we need an LLC for a backup plan? but I feel very strongly that liability insurance should always be your first line of defense against liability issues. Jeff and Sam, you got anything to add to that?
I was just going to add that, this discussion is important when we talk about policy limits, because your insurance as your first line of defense will protect you to, let's say, hypothetically, $100,000 is your policy limit. But if somebody gets injured on your farm, an employee or something like that, and they're trying to go after you, and your policy limits are $100,000, but they win a $1.5 million settlement, then all those assets in the LLC are at risk. You might have to sell those to make up for the amount that you still owe the plaintiff in that case. But that's why it's important to have those excess policies, the umbrella policy, but as the first line of defense. And then once you've extinguished your LLC assets, they can't go after your personal assets, right? So that's why this discussion is important when we talk about policy limits too, and how much those should be.
Good point. Okay. So I made a diagram of kind of a typical business structure that we might put together for a farming operation. And that might look like the farming operation that buys the inputs and sells the grain and sells the milk. That would be the farming operation LLC. We'd put the land in a separate, different land LLC, and then putting equipment, machinery, and trucks in its own LLC as well. So again, this is a very common business structure. And I also get asked about, well, should I put my equipment and trucks in its own LLC? I've heard that that'll protect me from liability. So like we've already been talking, that LLC may help with liability protection, but it's not foolproof. So let's take a look at why that is. So let's go next. So I've put here on the machinery LLC, that's where I consider the liability to be, is in the machinery LLC, because we've got big equipment going down the road. We've got grain trucks going very fast down the road, going into town to deliver grain or whatever it's doing. So we have a lot of liability with those assets. Our land isn't driving down the road. Our grain or our crops in the field aren't driving down the roads. That's why I usually figure the equipment and trucks are the highest liability. So what do we do about that? Well, we put up liability barriers. So by having a farming operation LLC and a land LLC, we put those barriers up to protect the farming operation and the land LLC from the liability of the machinery. But as you can see, it's not foolproof, because who is likely to be driving that tractor down the road or the grain truck into town? Well, it's probably going to either be an owner of the farming operation or an employee of the farming operation. And when that happens, it pulls that liability right back to the farming operation and bypasses those liability barriers we have between the entities. So the land is still protected. So land LLCs are a really good idea, but just putting your machinery and trucks in an LLC may not provide the liability protection that you intended, because of this issue that if something goes wrong with equipment and trucks, why did it go wrong? Good chance it was driver error. And that driver and the entity that it was driving on behalf is going to be liable for that issue. So that's that bypass of liability right back to the farming operation. So this is another example of why we need insurance and umbrella protection. So we've got this issue of, we've got 3 different LLCs, and that does provide some liability separation. So that's all good, but we still need more. And if you want to go to the next slide, Jeff, this kind of illustrates this is what we want. We want this insurance umbrella over everything. So whether we have an issue in the machinery LLC, farming operation, land LLC, regardless of where the issue is, who caused it, that this umbrella gives us liability protection over the entire farm. And this is why business entities cannot substitute for good insurance, because we can set up all the business entities we want and do all the tricks and strategies that we know, but you can't account for every possibility. But a good liability policy will cover a lot and will fill in those gaps. Okay. Jeff or Sam, anything to add there?
I don't think so.
Okay. All right. Next. All right. So the last topic I'm going to cover before I turn it over to Jeff and Sam is actual cash value versus replacement value. And so this has to do with property insurance. The previous topic about umbrella coverage and entities, that was about liability insurance. So now we're going to talk about a component of property insurance and actual cash value versus replacement value. So your property policy will typically have one of two ways in which property will be replaced or reimbursed. And the first one is actual cash value. And this is where whatever the property was worth at the time of the damage, that's what the insurance company will pay you. Versus the replacement value isn't necessarily what the property was worth at the time, but more of what will it cost to buy something that will do something similar in a similar state of repair and get you back to being whole or as close as we can. Replacement value is usually better than actual cash value because the replacement value is usually higher than the actual cash value. But replacement value will cost more because obviously the insurance company has more risk and has higher payouts if that will happen. So the premiums will be more. And you may not be able to get replacement value for all assets. So let's go to the next slide and I'll show you a couple examples. So this is a hay elevator that is on my farm, my family's farm, and that elevator may be as old or older than I am. That's the only elevator I remember ever having on our farm, and a windstorm blew it over and knocked it into fence posts, and that's the end of that elevator. And you can see it's old and it's not worth much in an actual cash value. So maybe it's worth a couple $100. But to replace this, to buy something that's going to be able to move hay up into the haymow for us in a similar way, it might be $5,000 or $6,000. So fortunately on our policy, we have replacement value. So when we submitted the claim, we were paid, I'm just going to guess, $4,000. And so then we could go buy something new. We actually bought a good used elevator for about that much. We were made whole. Everything worked out great. But if we would have had the actual cash value, the insurance company probably would have only paid us a few $100s, and we would have had to make up the rest. So that's why it's really important to know actual cash value versus replacement value. This is a relatively low cost, low value item. What if we're talking about a $500,000 combine? It can really matter a lot whether you have actual value or replacement value. So this is one of the questions to ask your insurance agent. Which do you have in your policy? You're better off having replacement value usually, but you may not be able to get it for everything, and it may be cost prohibitive. Okay, next. So this is another picture from my family's farm, and it's kind of hard to tell, but this is one of those March snows that we have in Ohio, and the snow can be really wet and heavy, and that's what happened here. And if you look at the barn, you'll notice right there where the grain bin and barn kind of meet, the roof collapsed. And so we got a heavy snow, the roof collapsed. This is an old freestall barn. We don't milk cows anymore, but my brother has beef cows in it. That's where he does most of his calving. So the barn collapsed, and so we made a claim. Now, for our policy, we weren't able to put replacement value on our buildings. So we were limited to actual cash value. I think the insurance company paid out like $170,000, which I thought was pretty generous. I hope they're not listening. But I thought it was pretty generous for this barn that was built in the mid-70s. But to build a new barn, it was going to cost about $300,000. So that, we had to make up the difference ourselves because we got paid actual cash value versus replacement value. So again, this is why you need to know the difference. Sam, you had made the comment before that buildings, often you cannot get replacement value on buildings. Is that correct?
So, buildings, you normally can, some insurance companies have a year restriction on, or an age restriction on roofs. 5 to 10 years is common, depending on what part of the country you're in. Also dependent on what insurance company you have.
Okay.
Some other kind of age variables is equipment. A lot of times insurance companies will not do replacement value on older.
Okay. So ask your insurance agent, right?
Definitely.
Okay. All right, let's go to the next one. Sam, I'm going to let you take this slide and talk about agreed values.
So agreed amount and agreed value, it's an endorsement that can be put on either a personal, so a homeowner's or dwelling policy, or a commercial property, commercial farm or property policy. And agreed amount / agreed value, you'll hear it called both. This is where you and your insurance company have agreed to the value of what you're covering. So you can get it on buildings, business, personal property, and sometimes you can get it on business income, just dependent on the company, the carrier, or your operation. To get agreed amount, so co-insurance, which we'll discuss later in the presentation, is waived on agreed amount. So in the event of a total loss, the insurance company will pay out the limit that you and your insurance company have agreed to. But to get this, you normally have to have a statement of value signed. And sometimes insurance companies will come out and do appraisals, or they can run what's called a replacement cost estimator to determine the value of your property. Statements of value are, of course, very important for this because the insurance company is agreeing to a limit that they're going to pay. So these have to be submitted typically every year, which requires some work on both the insurance part and the insurance company's part to make sure that the value of your property is accurate. For agreed amount, the limit on the policy must equal the limit on the statement of values. That way everything matches out. And like I said, this waives co-insurance, which is a penalty if you don't insure your building to replacement cost, or to a percentage of replacement cost. And like I said, that will be discussed later. Statements of value should be regularly updated to avoid underpayment of a claim if building costs go up or due to inflation. This is definitely something that to discuss with your insurance agent if you're interested. But it does take a little bit of work on the insurance part to make sure values are accurate, and it is more expensive typically, because of the limit is usually higher than actual cash value.
Yeah, this does seem like it would be a lot of work. Now, maybe well worth it, but how often would you say you see agreed amounts done? Is it common? Because I'd never heard of it before until you brought it to our attention.
It's fairly common on large schedules of property. I previously worked with some apartment complexes, some large schedules of like fast food restaurants. And it's more common on some like larger businesses than smaller operations.
And then is this just something that you would ask your insurance agent? Is this available? If it is, what would it cost? Is this something that your insurance agent can address for you?
Yes, definitely. I would ask, what will it cost? How often does that insurance company want an updated statement of values? Will they require any appraisals? Those kinds of questions.
All right. Okay, so next we're going to get into actually looking at the policy and trying to decipher some of the terms in there. If you've ever tried to read your insurance policy, you know that it is a difficult document to understand. When I started this project, I got our farm insurance policy and I said, well, I'll just read it. That'll help me understand insurance quite a bit. And after a few pages, I was like, forget this. I do not understand what it says. So they are hard to understand. And so if you have difficulty understanding yours, don't feel bad. Most of us don't understand them, but fortunately, Sam does understand insurance policies. So Sam, I'll let you take it from here.
Jack, can you go to the next slide? Okay, so I think the three main portions of an insurance policy are the declarations page, the list of definitions, and any additional coverages that are in the policy. So we'll start with the declarations page. That is the most important. It's going to have essentially all of your information about your specific policy. So it's going to have who's the named insured. It'll have the policy number and the policy period. The policy period being the start date and end date of that term. Normally it's a year. Sometimes with some auto policies, they will be 6 months. It'll have the list of coverages that are on that policy. So for example, for a property policy, it'll have the dwelling or building limit, any kind of personal property limit, any income limit, and then you can get some specialized coverages on a property policy. For example, if you have livestock, or sometimes equipment can be put on a standard property policy. So those will all be listed on the declarations page. And then it'll have your deductibles. Coverages can have different deductibles. So those will all be listed on there. Typically, the declarations page will also have a list of your endorsements, which are just extra things that are added to the policy. Sometimes they're required by the state. Sometimes insurance companies just like to add them for various reasons. And then the declaration page will also have all of your locations that are insured on that policy, class codes. If it's a general liability policy, class codes correspond to your operation. So if, say you're selling at like a farmer's market, you would have a class code for selling produce at a farmer's market. Say you're also selling like cooked food, you would have a different class code for that. And then the schedule will also include vehicles, equipment, and then any of those extra coverages I talked about. So that's the most important aspect to read on your insurance policy. And then next would be definitions. So each policy is going to have different definitions, a different list of definitions. I think that some of the big ones are who is an insured on that policy, because that matters as to who can file a claim, who can receive payment. And that's gonna differ whether you're a single insured versus a partnership or an LLC or a corporation. All of those definitions differ. And then insured location is also an important definition, because sometimes, for example, a vehicle is taken off of your location to use, say, in a neighboring farm. Well, if that neighboring farm is not listed on the policy and is not included in that insured stuff, in that insured location definition, it could limit coverage. So that's another kind of important definition to be aware of. And then the last important one is what is an occurrence on your policy. Insurance payments are all about whether the loss was classified as an occurrence. And so you want to definitely make sure you know what the insurance company defines an occurrence to be. And then lastly, any additional coverages. So policies can have some additional coverages built into the form, whether that's through the policy language itself or through those endorsements that I talked about. So for example, a farm property form has some built-in coverage for restoring farm operation records. If they're destroyed during a covered cause of loss. And so that form, I think, provides up to $2,000 per loss to restore farm records. So it's important to be aware of some of those additional coverages that are kind of built into the policy themselves.
Hey, Sam, when I looked at my farm policy, I was expecting to see, like, on the first page, the coverages and the deductibles, and maybe it was my policy, or maybe I didn't know I didn't know what I was doing, but I struggled to find some of this information. Like, is it generally going to be like on page 1 of the policy, or is it buried in there, or might it be spread out? How hard is it to find the declarations?
So it really depends on what insurance company you're with. Sometimes they're right at the very beginning after like the cover page. Sometimes they're, say, 5 or 10 pages in. Also, depending on the company, you could, if you have like a combination policy that has some property and liability coverage, you could have a property declarations page, and then say 30 or 40 pages later, you could have the general liability declarations page. Best practice to me is to just ask your insurance agent for your declaration pages. They'll be able to pick them out, and they'll be able to.
Okay.
So next, we're going to talk about insurable interests, because you can't be insured on a policy if you don't have an insurable interest. So insurable interests they're defined in state statute, or they've been defined through court cases. But generally, if an entity or person receives a benefit from the property or will suffer a financial loss if an insurable event occurs, they have an insurable interest. So some examples are, of course, property owners, because if a property, say, burns down, they will suffer a financial loss. Company owners, again, for that liability. Mortgage lenders have an insurable interest in a property, because they're supplying the financial backing for that property. Tenants have an insurable interest in what their kind of lease requires. So, for example, let's just use my apartment as an example. I have an insurable interest in all of my personal property that's in here, because I own it. So I have an insurance policy for my personal property. I do not have an insurable interest in the apartment building itself. I have no ownership. I would not suffer a financial loss to the building if the building, say, burned down. And then kind of opposite of that would be landlords. Landlords or property owners would have an insurable interest in the building, but may not have one in kind of the property of the individual tenants. Next slide. So who should be an insured? So this kind of goes back to what the definition of insured is on the policy. Owners of a business, if it's an LLC or corporation or partnership, or even a single owner, they're generally going to be included as insured on the policy, with the caveat of look at the specific definition of insured on your specific policy. Family members, if it's a single insured, the family members under kind of the standard policy, if it's an individual, it's going to be relatives of your household, anyone under 21 in your care, or students if they're under 24. So if you have a college age student who's out of your house but is away at college, if they're under 24, they would be included as an insured on the standard policy. And then in partnerships and joint ventures, the only family member that's considered insured on the general policy is members and partners and their spouses. So family members, it just kind of depends on that operation. On an auto policy, if a driver is a family member or non-family member, if they have regular access to a vehicle and regular use of the vehicle, they should be listed as a driver on the policy. So that's kind of family members. It just sort of depends on the specific entity type that is that the business is. And then for employees, under the standard liability policy, most employees are covered if they cause bodily injury or personal injury while in the scope of their business or while in the scope of their employment. But employees who are injured on the farm or business, unless it's an intentional tort, which Jeff will go into a little bit later, they would not be covered under a general liability policy. The proper way to cover an employee would be under a workers' comp or employer's liability policy. And then entities, Robert touched on that a little bit earlier. If you have a parent LLC and then a bunch of subsidiary LLCs, they can all be scheduled as insured on the policy. That's another thing to talk to your agent about, is if you have multiple LLCs, you would want to make sure they're all named on the policy. And then, so those were all kind of named insureds, additional named insureds. And then now we have this category of who should be an insured that's called additional insureds. And there's really two main categories here of who can be an insured on the policy. And that's an additional insured, which provides liability protection for third parties that may, like, due to the relationship, they could be brought into a lawsuit. And then there's loss payees, which provide first right of claim payments for property policies, property and automobile. So like in the case of like a mortgage holder, they would be listed as a loss payee because they have the financial backing. And so they're going to be the ones who are going to get the first right of claim payment in that case, if there's a total loss. So kind of an example of an additional insured for the liability protection would be a farmer's market. So if you're selling stuff at a farmer's market, the farmer's market may require you to list them as an additional insured on your policy, because they could potentially, if say something happens with your products that injures someone, the farmer's market could potentially be brought into the lawsuit. So they would want to be named as an additional insured on your policy to get some of that liability protection.
Do your premiums go up if you add, let's say, a family member or a business entity to your policy?
So if you're adding named insureds, normally not really. If you're adding drivers, yes, because each driver is underwritten by the company, so they're gonna look at driving record, age, things like that. And definitely adding drivers does increase premium on an auto policy.
A common kind of business structure that we see in Ohio a lot is maybe we've got two family members, brother and sister farming together, and they basically just split the expenses and split the income each year, but they may have, separate insurance policies. A situation like that, do you feel like, they ought to have one policy for the farm and everybody is a named insured? Or is it better to have separate, two policies? Do you get twice the coverage potential? And Jeff, I don't know if you have any thoughts on this, but are you better off having multiple policies or just one?
I don't have a lot of experience in that area. I think it would depend on, back to that insurable interest, who has an insurable interest in what. I think that would be definitely something to discuss with an agent to see if that's even an option. I don't know, Jeff, did you have any more kind of insight into that?
The only time I've ever dealt with two insurance policies covering the same property damage or liability was a rental car, and you're in the driver's personal insurance. So the whole argument was who's going to be primary insurance and then who's going to be secondary insurance. But if you're in a situation where the brother and sister have the same insurance company, maybe that issue doesn't arise. But I've very seldomly dealt with primary and secondary insurance issues. But it does create an issue if you have two separate companies saying, no, you need to pay out first, and the other company says, no, you need to pay out first. So that does get kind of tricky.
So there could be some advantages to having one insurance agent, one insurance company do all the coverage. Okay.
So kind of back to what Robert was talking about with the additional premium for kind of adding these entities, additional insureds definitely cost money to add. Some insurance companies will charge per additional insured. Some will allow you to have like it's what's called a blanket additional insured, where essentially if you're required by contract, then you would have additional insured status. The blanket, I've seen it mostly on large contractors that have lots of subcontractors and things like that. So it just kind of depends on the insurance company.
Okay.
Next slide. So when to add an asset, the easy answer is when you have an insurable interest in the property. When if a piece of property, whether it's building, equipment, vehicle, if it were to have a total loss or even any kind of claim situation, if you were to suffer financial harm, you have an insurable interest, so that's to go ahead and add it in. Most dealerships of equipment and vehicles will not allow you to drive off the dealership without some sort of proof of insurance. So as soon as you know kind of the VIN number or the serial number, it's best to just go ahead and call your agent, or if it's the weekend or kind of after hours, if you have a direct line to the insurance company, it's best to just go ahead and add it then. For new construction of buildings, there's a type of policy called a builder's risk. Sometimes you can also get construction endorsements on a property policy to cover property under construction. That way, any kind of claim that occurs, as long as it's covered by the policy, you would have financial protection for property under construction.
Just an example of that, at our farm show that we do each September, Jeff and I did a presentation on insurance, and afterwards somebody came up and said they had bought, I think it was like a track hoe or something, from another farmer. It wasn't a dealership, and just never thought about adding it to the policy, just slipped their mind, and it caught on fire and burned up. And I'm guessing insurance companies probably don't have the attitude of, oh, well, you meant to add it to your policy, right? I mean, it's either on there or it's not. You might have a few days or something of grace period, but it's either on or it's not, right?
Some insurance companies will give you a grace period. Again, it's gonna differ depending on the insurance company. It'll be a few days, some it could be up to 30 days. But you really don't want to rely on that, because things happen, people get busy, things slip your mind. And it's really best to just go ahead and add it while you're in the process of purchasing the equipment or vehicle.
Yeah.
Next slide. So now we'll talk about co-insurance, which I mentioned a little bit in the agreed value, agreed amount discussion. Co-insurance is a clause in your policy that says that property has to be insured up to a required percentage of the replacement cost. So we have an example here. And this is to receive full reimbursement of the claim. So in this example, say you have a barn. The replacement cost of that barn is $1.5 million. And the co-insurance requirement is 80% of replacement cost. So that basically what that is saying is the insurance company is telling you that the building limit on your policy must be 80% of that $1.5 million. So over on the kind of the right-hand side, you'll see that I did the math. So the limit of building insurance required on this policy would be 1.2 million. So you can
just cut back, just to make it that clear. So what you're saying is, like, when you report or you do your inventory for the insurance company, you better make sure that you're paying premiums based on at least $1.2 million value of building, right?
Correct.
Yeah. And if
So-
you try to say it's only $1 million to try to save some premiums, the insurance company knows that scheme, and this is to kind of prevent that.
Correct. And so insurance companies will use different percentages. The most common ones I've seen are 80% and 90%. So for this example, I use 80%. That's the most common I've seen. And so in this example, the building limit that the insured has on this building is $1 million. So you can already kind of see that they were required to have 1.2 million, but they only have 1. To the next slide. So this is where the formula comes in for the claim payment at the time of a claim. So in this case, we're looking at this first part of the formula, which is the limit that the insured had on the building divided by the limit that was required to be had on the building. So in our example, the limit that the insured had was 1 million. The limit they were required to have, based on that calculation we did in the previous slide, is 1.2. So in this case, the insured only had coverage on 83.3% that they were supposed to have. So the next slide. So now we'll take it to the next part of the formula. And so in our scenario, it wasn't a total loss. The amount of the loss was $800,000. So you take that percentage that we just calculated in the last slide, which was the limit that the insured had divided by the limit that was required by the co-insurance clause. And you multiply that by the amount of the loss. So in our situation, it was 83.3% times the $800,000 loss, which gives us $666,400. So you can see there that by not having adequate limits, right off the bat, the amount of payment is reduced by 134,000, a little less than. And then next slide. And then lastly, out of all of that math we just did, then you subtract out your deductible from your policy. So in this case, the deductible on the policy is 5,000. So you take that number that we calculated in the last slide, which was 666,400. And then you subtract out the deductible. And so the 661,400 would have been the claim payment that this insured would have received. And so in total, the deduction was 140,000 basically. And so by not insuring to the requirement by the co-insurance clause, you just cost yourself $140,000 out of pocket, versus paying the additional premium to get up to that 1.2 million requirement in our case, which likely would not have cost 140,000 to insure that little bit of extra.
Yeah, I had never heard of co-insurance. I can see why the insurance company wants it, because if you're not paying your fair share of the premiums, then they're basically saying, well, we're gonna make you co-insure the property, correct? So is this all about making sure that you provide the insurance company with realistic values of the property you're wanting insured, or you're going to share the risk with the insurance company?
Correct. Yeah, that is
Okay.
what all this is about. They want to make sure that you are paying for
Mhm.
what your building is worth.
Okay.
So now we're gonna switch gears a little bit and go and talk about some common exclusions that are on both the liability and the property policies. Exclusions are added for various reasons. Sometimes the exposure is outside of the scope of what the insurance company wants to cover. Sometimes the exposure is better covered on other types of policies. So for example, on the liability policy, this is the standard farm liability policy. Pollution is typically excluded, or it'll have some sort of like very limited coverage, because this exposure is better covered on an environmental policy. Vehicles, if they are, normally it's if they're registered for use on the road, they're going to be excluded. Because they should be covered on an automobile policy. Custom farming, this is an exposure that some insurance companies just don't want to take on without additional premium, additional underwriting by the company themselves. And so that there's an exclusion for that on the standard farm liability policy. Business pursuits, is properly covered under a commercial type of policy, where the company is underwriting it for those like special exposures for being a business or having business pursuits. And then agri-tainment. So standard farm liability policy has an exclusion for agri-tainment or agribusiness. These exposures are normally outside of what a standard farm policy wants to cover. There's more liability, sometimes exposure, sometimes there's more property exposure, like property exposure, and then product exposure there sometimes if you're selling products. So those are all kind of the common liability exclusions. And then on the property policy, land is almost always excluded. I'm not really sure why, but on the standard property policy, that is an exclusion listed. And then growing crops, these are crops that are covered by crop insurance typically. So they're gonna be excluded under a property policy. Business property under standard property policy will be excluded, because that should be covered under a business property policy. And then flood, sometimes earthquake, sometimes hail and wind, depending on like kind of what part of the country you're in. Those can all be excluded also, because those have individual policies that you can get. And they're also normally outside of the scope of what a standard property policy wants to cover.
So Sam, if something is excluded, is that like the end all be all? Is that's it? There's nothing you can do about it? Or are there ways to get coverage for those exclusions?
There are ways to get coverage for those exclusions. Sometimes you can get those covered under separate policies, like for example, the vehicle policy or the vehicle exclusion you would have covered under an automobile policy. Sometimes your agent can negotiate with the insurance company to get something covered. Those are really the two biggest scenarios, is you either purchase a separate policy, or your agent may be able to negotiate. It just kind of depends on what it is you want to have covered. So like, for example, growing crops, your agent is likely not going to be able to negotiate coverage for growing crops, because that's covered under crop insurance. And so with additional policies comes also additional premium usually. And so then next slide. And so I think to kind of finish up my area, I'm going to talk a little bit about insurance agents and the role. So they're an important member of your farm management team, because they have the specialized knowledge of your insurance, and hopefully they have the specialized knowledge of your operation, as long as you're sharing with them kind of what your operation entails. And then like it says, and like kind of Jeff and I just had a conversation about, almost anything can be covered, but your agent has to know. They have the knowledge of the products. If you have something that you want to be covered, they should be able to find a solution. And so insurance agencies and individual insurance agents, they're all regulated at the state level by state departments of insurance, state bureaus of insurance. They all have to be licensed with the state to sell, solicit, or negotiate insurance policies. So because I am licensed in Virginia and North Carolina, I can sell, solicit, or negotiate in Virginia and North Carolina. But for example, I could not sell, solicit, or negotiate in Ohio or Arkansas. And then to become an agent, all states require a licensing exam for what's called property and casualty, which are the lines of coverage that we're talking about here. Some states require some pre-licensing education, and then all states require agents to complete continuing education credits. So for example, Virginia requires me to complete, I think 16 hours every 2 years. So different states have different continuing education requirements, and there are some limited exceptions to who has to complete continuing ed. So for example, I don't have to complete different continuing education credits for North Carolina, because North Carolina accepts what I do in Virginia as sufficient. Next slide.
Oh.
And so a little bit about how to find an agent. There's kind of three main methods. Asking around in your community, family and friends, asking similar businesses who they have their insurance with. That's a good way to get an agent, or to get an idea of what companies are writing similar businesses. going on search engines online, that's a helpful tool to look, what agents are operating in your area. And then individual insurance companies also have a find an agent feature on their website. So if you have a friend or family member in a different state that says they're with ABC Insurance Company, you can go on that insurance company's website in most cases and find an agent in your local area that does business with that company. And then how do you know if you found the right agent? This really goes back to asking the right questions. If you're an agricultural business, you can ask if they have other agricultural clients. Are they familiar with agriculture? Do they themselves farm? Do they have experience working with clients who work in agriculture? Do they represent companies that have experience working with farming and agriculture businesses? And then do they have an errors and omissions policy? Most agents will have, most if not all agents will have an errors and omissions policy. And this policy will cover the agent and the agency if one of their sales team, account managers, if somebody within that agency makes a mistake. So if they, for example, if you tell your insurance agent that you purchased this piece of equipment, you'd like to add it to your policy, and they fail to add it to your policy, their errors and omissions, the agency's errors and omissions policy would kick in if you had a loss on that piece of equipment. Next slide. So some more about agents. You have kind of these two buckets of types of agents. You have what are called direct writers and independent agents. So the main difference is direct writers typically have access to one company. They do all of their business with that one company, and then independent agents have access to multiple companies. It's really a personal choice as to which type of agent you want. There's pros and cons of both, depending on various factors. And so that's really the big difference, is one company with direct writers, multiple companies with independent agents. And then a big question to discuss with your agent is, are your assets and activities covered? So Robert put together this list of different activities and assets that may or may not be covered under policy. It's available on the Ohio State website. And if you have any of these types of exposures, you definitely want to ask your insurance agent if it's covered on the policy that you currently have. If it's not, they can either recommend a different type of policy. They can recommend some additional policies to get those activities covered. But that's definitely a conversation to have with your insurance agent. And so then next steps for any kind of agricultural business, farm, is to meet with your agent. Discuss what building limits you have. Are they adequate to cover that co-insurance penalty if you have one? Are they adequate to, depending on replacement cost or actual cash value? Then liability limits. Are your liability limits adequate to cover your specific operation? Different policies will have different maximums of what limits the insurance companies will offer. If the limit that the insurance company will offer is not high enough, based on your kind of conversation with the agent, then you would want to consider umbrella policies or excess liability policies. And then definitely discussing any vehicles and equipment you have, make sure that they're listed on the policy. Again, any activities on that farm activities list, and then additional policies that may be available for your specific operation. After kind of the conversation with your agent about what your operation does, they would be able to recommend any additional policies that would provide additional coverage. Next slide. And so then lastly, the National Ag Law Center, like I said, is a division of the University of Arkansas Division of Ag. We provide nonpartisan information on various legal issues. This is just our website QR code and a QR code for the feed, which is our biweekly newsletter that highlights some of the major agricultural related legal issues that have come up in those 2 weeks. And then lastly, it has our social media where we post articles that our attorneys write, partner articles, and just different information about legal issues. And with that, I will turn it over to Jeff.
Hey, Jeff, could you go back to the list of activities? I just want to make a couple comments. So that list, what we try to do with it, or the way we try to design it is so you can hand it out to clients if you work with farmers. You take that list and you just check off any of those that apply to you. You hand it to the insurance agent and say, make sure all these are covered. So that's the intent with that. And I guess the purpose behind this, or how I came up with this, on our farm, we lease out to hunters. And I just always assume that, of course, our hunting leases are covered under our farm policy. I just happened to ask our insurance agent, and the hunters were not covered. Unpaid are covered, but not paying hunters were covered under our policy. We got it added very easily. Premiums went up, but it was easy to add the hunting lease to our policy. But until I thought about asking, we had exposure there. I worked with a client that he pulled floats in the July 4th parade with one of his tractors, and he happened to think, am I covered if something would happen while I'm driving in this parade? And he wasn't. Now, again, he got something added to his policy and he's covered now. So it's just those kind of things that maybe you wouldn't think of, that this list can help stimulate some, well, maybe I better check on this. Let me give this to my insurance agent. So I just wanted to touch on that. All right, over to you, Jeff.
Right, thank you. And I will say that in my early years as an attorney, when I did start working for the insurance defense firm, reading an insurance policy is a science. And we spent months and months as new attorneys learning how to read an insurance policy just for our edification on, claims that were made and whether or not coverage applies. So Sam threw a lot at you. And if you feel a little overwhelmed, don't worry. Everybody does when that comes out at you. So I just want to make that point that reading and understanding insurance policy is a long process, and it'll take some time, familiarity with your insurance policy before it really starts to click. But I'm going to switch gears and get into the fun side of insurance and talk about.
Wait, there's a fun side of insurance? I was not aware of that. So
this is definitely the fun side. The
Okay.
most fun you'll have with insurance is when you have an insurance claim. And so the most important thing I want you to remember is that the nature of the relationship between you and your insurance company, and that it is a relationship governed by contract, which is the insurance policy. Both you and your insurance company have obligations and duties to fulfill under this contract. And so if you don't fulfill those, coverage might not exist, coverage might be canceled, or on the reverse side, if your insurance company isn't fulfilling their duties and obligations, you have recourse. And in Ohio, we, as insurance defense attorneys, did everything we could to make sure our insurance clients were not abusing or not or neglecting their duties under an insurance policy. And you may be asking yourself, well, I've never had to sign anything. I know Robert's asked me that before. I've never had to sign anything when I applied for insurance or got my insurance policy. And you got to read the fine print. So sometimes you'll have insurance policies on the declarations page that Sam talked about will say, in return of payment of premiums, you agree to abide by the terms of this policy, of this contract. I've even seen where when you apply for insurance on a company's website, they will have those little check mark boxes that you click on, and it's just saying, this will create a contract, you'll be obligated to do certain things. And so the insurance company, one of those shrink wrap contracts that you have that we talk about in law school that no one reads, right? So it is an insurance policy, but it is the contract, and that's what governs your relationship with your insurance carrier. And because of that, we talk about handling insurance claims. There are two primary claims that I'm going to talk about today. There are other claims, and we'll touch on them, but the two primary ones I want to focus on are first-party claims and third-party claims. So a first-party claim is that you yourself, as the insured, make the claim to your insurance company yourself. And the best example of that is that your barn burns down. And so no one else is making a claim except you, the insured. You want to get reimbursement for your loss, and that's when you're making a first-party claim. Now, a third-party claim is when you have someone on your property and either their property gets damaged or they themselves get injured and suffer some damages. And that is when you get sued. And so when you're getting sued, that we call that a third-party claim, because an outside party from the contract is making a claim against your insurance and trying to recoup or get reimbursed for their loss. And so the best example of that, not the best, but one example of that is someone slips and falls at your pumpkin patch that you're operating, and now they're suing you for the resulting injury, and that'll be a third-party claim. Those other claims that I mentioned were, if you want to call them claims, are subrogation and bad faith litigation. And we'll get into subrogation. It's where the insurance company kind of takes over as the insured because they've already paid you as the insured. And then the bad faith litigation is what I was mentioning. If your insurance company does not fulfill its duties and obligations under a contract, then you as the insured can sue them for bad faith. And that's when it becomes a big no-no, because in Ohio, we also not only provide compensatory damages, so you don't only get the money for your loss, but there are also punitive damages, so damages that we assert to punish the insurance company for not fulfilling their obligations under a contract. And so insurance companies do their best to avoid that at all possible costs. So what happens if a claim arises? And we're going to use this one right here. This is going to be a first-party claim, right? So my barn has burnt down. Now what? Well, you want to make sure everyone is safe. That's going to be step one. Step two, make sure you call emergency services. Make, the fire is out. Everyone's safe. We're going to do those. Those should be immediate. We're probably going to call your family, your friends, let them know you're okay. Everything's fine. But something that people don't realize is that within your insurance policy, you have a duty to alert your insurance company of a potential claim as reasonably as possible, as reasonably as soon as you can. So in my discussions, it's one of the things when you're thinking about this, call them right after you've done the emergency services and you've let your family know you're okay, and let them know, hey, I'm going to need to make a claim because my barn has just burnt down. And the reason that's important is because insurance companies will want to investigate to make sure that they're just not paying out on fraudulent claims, right? So they don't want to be prejudiced in their investigation. So the earlier you call them, the easier it is to collect evidence, see what happened, and no suspicious questions will arise from your insurance company about the claim. And then lastly, you have a duty as an insured to cooperate with the claim investigation. And we'll get into that, what that entails. But one of the important things that I was mentioning is we don't want to prejudice your insurance company. So, your barn burns down. If you're not thinking about calling your insurance company, one of the first things you're thinking about is like, well, how do I get this burnt pile of rubble off my land and my property? And don't do that until the insurance company has given you the okay, because they're going to want to come in and investigate and make sure that there was no foul play, that this was accidental. Probably have a fire marshal go through it as well. But if you start to clean that up, it looks a little suspicious, and it might trigger some questions. Might be innocent on your part, but that's just one of the things that people don't realize is like, make sure you get the okay from your insurance company before you go in and start messing with the evidence of the loss.
Hey, Jeff, speaking of barns burning down, I'm just curious, is arson typically covered under a policy? Or since that's an intentional act, is it often not covered?
So as long as it's an intentional act, not by the insured, in most of my experience, that's been covered, right? So as long as the insured hasn't caused it themselves, usually that's what you pay insurance for, right? If that arises. Now, if the insured, for example, running and operating a failing business, and they decide to burn down the barn to recoup some investment, that's not going to be covered, typically under a policy.
But it's been tried, I'm sure.
Oh, I've seen a few of them for sure. So the first party claim investigation, as I was saying, you have the contractual obligation to cooperate with any claim investigation. And so what does that entail? That usually means answering some questions, providing evidence. And we, a lot of times, have our insureds, when I was working as an insurance defense attorney, we would have our insureds submit to an examination under oath. And this is some big, scary, seems like a court proceeding, but it's not. It is sort of like a deposition. I will say it's almost exactly like a deposition, except the rules of evidence do not apply because it's a contractual obligation and not a civil or criminal proceeding. So these EUOs are sworn testimony just about the claim. And these are usually just ways for the insurance company to either gather evidence to support the claim being covered, and or to find any evidence of where they might be seeking, that this is a fraudulent claim or that coverage does not exist for certain different exclusions or reasons. And so that goes into the purpose of a claims investigation is to determine whether or not coverage exists, and most of the time it does. So don't be afraid when you're being subjected to an EUO or having to answer all these questions. The insurance company, the adjusters, and those defense attorneys that are being hired are just doing their job to make sure that coverage does exist. And like I said, most of the time it does. And I will say from personal experience, we like to err on the side of coverage existing because of that bad faith litigation. And so a question I've received a few times about claims investigation, especially in a first party claim, when do you get an attorney? Because the insurance company is asking you questions. Should I get an attorney right away? That is personal preference. I've never seen the fee arrangement between an attorney and an insured and how that works out, because all of this that's going on in a first party claims investigation is all contractual. So if you don't do what the insurance company is asking you to by submitting to an EUO or answering questions, they can deny coverage. And so I don't know what an attorney is going to do at this point, but if you feel safer as an insured, more protected, then it's up to you to pay those legal fees.
If the insurance company asks to do an EUO, should you be concerned as in like, will they suspect something, or is it usually just the process? It's nothing to really worry about.
Yeah, so imagine an insurance company like Nationwide, just because they're here in Columbus. there are so many layers, right? Where the person I'm working with as an attorney wants the evidence and the facts to prove to their supervisor and vice versa. So I wouldn't say they suspect something. They just want when a supervisor up the ladder looks down at this claim and why we covered it, then with that EUO, they could have the evidence. They'd be like, well, they said this, that's why they testified to this. There's coverage for that, for that. And then the flip side is sometimes we submit people to EUOs because we do suspect something, but they happen in both cases. So some of the first party investigations I've seen, and the one that you typically see, are coverage issues. So we're going through and doing those EUOs, asking questions, investigating a property because we want to make sure that no policy exclusions apply. That's what we as an insurance defense attorney are paid to do. And like I said, usually coverage does exist, and we err on the side of caution. Another coverage issue thing that I wanted to discuss is when you talk to your insurance agent, make sure you recap any phone conversations or in-person conversations with an email just confirming what you talked about. I had one case where a couple was remodeling their home, and a lot of people don't know this either, but remodeling your home under your homeowner's insurance policy might not be covered if there is an electrical fire or something of the sort. And that's exactly what happened. So this couple remodeling their own home did not get a contractor as required by the insurance policy, and they burned down their house. Well, the insurance agent allegedly told the couple, oh yeah, you'll be covered, it's fine. And when it came out that the insurance agent said that, allegedly, the insurance agent claimed that they didn't. And so the couple, that's when you see the worst side of humanity is the couple didn't get coverage for their home burning down because they didn't hire a contractor, but they were adamant that the insurance agent said they did. Had they got something in writing confirming that the insurance agent said, yes, there is coverage for that, because the insurance agent is acting on behalf of the insurance company, we probably would have suggested coverage. Now, the other type of investigations I've seen are fraud. And this is the one where we will submit people to EUOs because of potential issues that coverage never existed in the first place. So some of the things I've seen, one spouse will intentionally burn down property to spite the other. Arson, as we discussed before, is not going to typically be covered by an insurance policy. If it was, sorry, someone just walked in on the little kid. If someone does the arson themselves, if one of the named insureds does the arson, then it will not be covered. And then we've already discussed failing businesses will intentionally destroy business property to recoup investment. So now what happens if a third-party claim arises? And so someone's been injured on your property. Well, you want to make sure they're safely removed. And usually you will never know that there's going to be a complaint until a lawsuit does come to your front door. And so when that lawsuit comes to your front door, that complaint, you want to send that complaint to your insurance company. And I step back 1 minute here. I say in step one, collect evidence, and that's at the end. I'm talking about if somebody trips over a rock or an exposed pipe or whatever it might be on your property and is injured, you want to look at that and take pictures of what that day was like. It could help your defense. You want to surrounding area, surrounding circumstances, all that stuff. You just take pictures and stuff like that. You don't have to pull the pipe or collect the rock itself, but you'll just want to make sure that you document what happened, and it might help your defense in that case. So then we just talked about if any complaint comes to your front door, make sure you send that to your insurance company. And what your insurance company will do at that point is hire attorneys on your behalf. And those attorneys will be working with you and with the insurance company to provide you a defense. Now, you also have the obligation, you just can't be done with it and say, okay, attorneys are going to take care of it. You have to cooperate with the insurance company and those attorneys in the litigation process. And that's when you're going to be subjected to depositions. You know, they'll want all the evidence that you've collected. You'll have to be answering questions, and then you'll have depositions from the plaintiff side, all of those things that you might want to be present for and cooperate with. So one of the things we already mentioned, that in third-party claims, defense attorneys will be hired for you. If you are probably at fault for the injuries, if you say, yeah, well, that pipe, I should have taken it out years ago, or whatever it might be, the insurance company and the attorney will do their best to settle the claim on your behalf within policy limits. So that way you're not having to be exposed to any personal liability above the policy limits. And we talked about that earlier. If your policy limits are $100,000 and someone's injuries are worth $150,000, if that $50,000 isn't settled or isn't reduced by the plaintiff, then you would be on the hook for that personally. And lastly, you don't have to use the attorneys actually hired by the insurance company, but if you want to hire your own attorney, you will most likely be responsible to cover all those legal fees. And it will not be, essentially, with your premiums, you're paying for a free defense counsel. If you want your own, that's going to be on your own, out of your own pocketbook.
Hey, Jeff, one thing I've heard people say is, the more insurance coverage you have, the more the insurance company has at risk. So the harder they'll defend the claim. Do you agree with that? Or as a defense attorney, did you put the same amount of effort, whether it was, the insured had $100,000 of coverage or $5 million of coverage?
Well, I'm a people pleaser, so I always I did my best. And I will say that probably was the sentiment of everybody, regardless of coverage. We would do our best. And even though some folks had more coverage than others, it was the amount of the claim itself that we were exposing, that the client was exposed to. So I remember, for example, I had a $1.5 billion claim against a bail bonds company that I was representing, and they didn't have 5 million. They didn't have $1 million. They might have had $1 million in coverage, but it wasn't anything close to covering 1.5 billion. But we put just as much effort into that as we did. I represented a major retailer, and they had boatloads of coverage, but they had a claim for 150,000. So, the amount of the claim itself and the amount of coverage might not always be what's at risk, right? So, and then we tried, and insurance companies also wanted us to defend their clients as well as possible, because that keeps them as their client as well. So just some of the third-party claims I've seen. Myself, I've seen some workplace injuries, some gruesome sites and evidence collecting in those cases. I did have a young woman. She was degloved in her place of work while she was at a paper mill, and her hair got caught in one of the machines and it ripped the top of her scalp right off. Some slip and fall injuries. I mentioned a pipe sticking out of the grounds because someone tripped over a pipe on someone's property and was suing for an exorbitant amount of money. Automobile injuries all the time. Two of my most interesting cases actually involved horses. There was injuries caused by an escaped horse. A motorcycle man actually almost passed away after he hit a horse, and the horse had escaped its enclosure. And in Ohio, you have a rebuttable presumption of negligence, that the horse owner had to prove that they did everything that they could to keep the horse enclosed. So that was an interesting case. And then veterinary malpractice. I had a lot of horse owners suing veterinarians for the passing away of their horses that we defended. Just had a question pop in. Do you see farm insurance policies having the ability to obtain a choice of counsel endorsement? That's interesting. I've never come across that. I will say that insurance companies really like using their insurance attorneys because we charge a lot less per hour than your other attorneys might. So that might be a possibility. I have no idea. Sam, do you know anything about choice of counsel endorsements?
From recollection, I don't remember seeing a choice of counsel endorsement. It may be an endorsement. This is just kind of speculating. It may be an endorsement that's available depending on what state you're in. Because most endorsements have to be approved by the State Department of Insurance. If it's a company that's regulated by them, which is most companies. But I don't recall ever seeing a choice of counsel endorsement.
Would it
And if
be-
there is, oh, for me, if it exists, then I would have never seen the case.
But it would be a good question to ask the insurance agent, right? Is that a possibility if you want the ability to pick the attorney that's going to defend you? I think it's a great question.
Yeah, and that goes into I see that having more of a power struggle between the attorney and the insurance company, because who is the client of the insurance defense attorney? And for me and everybody that I've ever worked with, it was the policyholder, the insured, and they're the real life people that we're dealing with when these cases arise. So you start to feel for them, and you definitely want to protect their interests, and you get to learn about them, and that's who your client is. But there is still definitely a little bit of a power struggle there because the insurance company does pay the legal bill. So when it comes to, I want to spend hours and hours and hours in discovery looking for something that might help my client, the insurance company is probably not going to be like, yeah, we're not paying you to do 12 hours of discovery. You might get 2 out of that, just stuff like that. So insurance attorneys do have to be beholden to who's paying the legal bills, but their interest and their duty is to the policyholder, the insured, to make sure they get the best representation possible. So yeah, that would be a great question, and I would like to see how that power struggle would work out between the insurance company and someone's choice of attorney. So we've talked about first party claims and third party claims, and now what do you do if your insurance company denies your claim? So you probably have some policy provisions within your policy that say you have to follow a certain internal appeals process, and you'll want to do that because otherwise you're in breach of contract if you go straight for a lawsuit. Now, I've seen lots of times once the appeal has gone up, they will then say, yeah, coverage does exist, give them coverage, provide them for the loss. But it could go all the way up and still be denied. And if you really feel adamantly, and there might be case law out there, and that's where we talk about definitions, and Sam mentioned this, you have the definitions within your policy, but there's also court-made definitions. So it's really tricky when you get to the definition section of your policy and you see the word or a list of things that are not covered. So, fire, flood, and hail, just for example. Now, does that and mean all 3 aren't covered under here? There's always been those types of lawsuits out there. So we as attorneys have to not only look at the policy, but also at court cases that help define the definitions. But as if you really feel that your insurance company has failed in their duty to represent you or failed to provide coverage for an insurable claim, then you'll want to get an attorney and file a bad faith litigation lawsuit. And as I said before, in Ohio at least, we not only give compensatory damages for the loss, there's also those punitive damages that you can get from your insurance company for not doing their duties under the contract.
Jeff, I think I didn't know really about the bad faith litigation. My attitude, kind of my cynical attitude, has been Well, insurance companies probably look for any way possible to deny the claim. But because of the punitive nature of bad faith litigation, I'm hearing you say that isn't necessarily the case, that there are some real teeth in this bad faith litigation, and an insurance company would really takes it seriously about denying a claim. Is that accurate?
For sure. And this is what the law how the law balances power, right? So we have these big multinational corporations and these insurance companies dealing with your local farmer, and the power imbalance is huge. But this bad faith litigation is a way to kind of balance those scales, which is why I have those scales there, to give the farmer some teeth, as you were saying, to say, if you don't do what you're obligated to do, and I sue you because of that, you're going to pay me for the loss, and you're going to, it's usually double what the loss was in punitive damages. You're going to pay me double, essentially. And insurance companies, one, don't want to pay for the defense counsel to defend them. And then two, also potentially pay double what they were going to if they just covered the loss to begin with.
And
So
get a reputation for not paying out too.
exactly. And then they'll not have any clients, and then they'll go under. So there definitely is bad faith litigation as a way to balance the scales of power. Another question we get a lot, Robert, and you and I worked with this at the farm show we had, is employees and workers' compensation issues, and whether or not an employee, if they get injured on the job, are they covered under your liability policy? And in Ohio, at least, and with talking with Sam, at least in other parts of the country, workers' compensation is going to be what covers workplace injuries. And unless an employee can prove there was an intentional tort, that an employer, for example, did not put a PTO shaft guard on a PTO shaft, and the employee's arm gets caught in there, and they can prove that the employer did it intentionally, then that's when your liability policy might kick in. But for most employee workplace injuries, that's going to be workers' compensation. So that's when we get the questions, well, I pay somebody under the table, or, I take the local kid and he just bales some hay for me. Well, those informal employees, as an employer, you're running the risk of exposing yourself for not carrying workers' compensation. And because you are skirting the law and not defining this kid as an employee on your farm or the person you're paying under the table, your policy probably has an exclusion for you not following the law, and probably won't provide coverage for any injuries that result to that employee or who should have been labeled an employee. And then just a few more slides. My last slide here. So I mentioned subrogation, and subrogation is where the insurance company gets to step into the shoes of one of the insureds. And so you see this a lot. Sorry, just another question, just real quick. If you 1099 the worker and report that amount to workers' comp, would they be covered? So in Ohio, as far as I understand it, if you're saying that the worker is an independent contractor, then you would not need workers' compensation coverage at all if there's no other employees on the farm. Correct me if I'm wrong, Robert.
Jeff, I think maybe what they're asking is if you don't put someone on payroll and collect the FICA taxes, are they still subject to workers' comp? And this is the very question.
Oh, okay. Now I see.
We asked workers' comp at the farm show, and our understanding is as long as you report, if you paid somebody $500 to bale hay and you just paid them cash, you didn't deduct payroll taxes, as long as you show workers' comp that you paid them $500, you report that the next time you report to workers' comp that it is covered. even though maybe you didn't withhold taxes like you should have, it is still covered under workers' comp. Is that your understanding, Jeff?
Yes, yes. No, that question now makes more sense. Yes, thank you.
Mhm.
All right, so subrogation, as real quick, the insured, you see this a lot in automobile accidents. You get into an automobile accident and it's someone else's fault. The insurance company, your insurance company, will pay out the claim, right? They'll pay out, you totaled your car, the car's been totaled, your insurance company will pay you that claim. Okay. And now what you've signed away in your insurance policy is that your insurance company can now step into your shoes and go after the at-fault person and their insurance company to recoup that loss. So you're now out of that potential lawsuit because you've already gotten your money back. You've already recovered your loss. So now the insurance company is going to step into your shoes and sue the other person for that money. I've also seen this, a big one here in Ohio. A contractor negligently caused an electric fire in a hog barn. So kind of like the cow example we had earlier, but the hog barn burnt down. So the hog farmer makes a claim against their insurance company, against their insurance policy, and the insurance company had to pay the claim because it was covered accidental fire. And then the insurance company took legal action against the contractor and the contractor's insurance for the damages that were sustained on that hog farm. So at least in this instance, I forget what the policy limits were, but it was in the millions of dollars that the insurance company had to pay out to the hog farmer. And then that's what they went after the contractor for. And another question we get asked a lot is, well, how involved would a hog farmer be in that specific example? And I would say pretty involved in the lawsuit. Even though they're not the one recovering the damages, they're going to be subject to depositions and witness testimony and stuff like that. So there will be some involvement from the farmer for that. And you'll have to cooperate with the insurance company in that as well. And with that, I leave us a couple minutes for questions if anybody's got any.
Yeah, while we maybe see if any questions come in. So here's all our contact information. So if you have any follow-up questions, or we can be of any help to you, there's our emails. Feel free to contact us at any time. Our PowerPoint slides are available if you'd like to review them for whatever reason. And we did, the three of us put together a pretty substantial publication on farm insurance. And you can get that at the farm office website and that checklist as well. And those publications are also at the National Ag Law Center website that you can, the little squiggly thing, I forget what you call that. But it looks like no more questions and we're just about out of time anyway. So, oh, one last thing. The reason we recorded this is we are going to post it to YouTube. So for some reason you'd want to watch it again, or if you'd like to refer someone to it, we'll post that on YouTube and you can get it through our farm office website and probably through the National Ag Law Center as well. So appreciate everybody that took time out of their Thursday evening to join us. Hopefully we gave you at least something to think about. And again, something to talk to your insurance agent. And that's really the main thing, is just keep your insurance agent in mind, keep your insurance policy in mind, ask questions. That's part of the insurance agent's job, is to address your questions and make sure that you are fully covered. So Jeff and Sam, any concluding thoughts on your part?
All good over here.
I don't think so.
Okay. Well, thanks everybody for joining us, and we'll see you next time.